Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments, and PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We would like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, John Coffey, Columbia Law professor, author, and much more than that will be our guest. So listeners have a high-level sense of our roadmap for today. We will start with some background, then discuss securities law and governance as they pertain to investing. Investors and business leaders should be able to extract a great deal of value from John's insight. On that note, welcome, John.
Good to see you, gentlemen. I'm happy to participate.
Great. Your background is long and illustrious, so we won't go through it in its entirety or detail, but perhaps you could give us a few highlights that you're particularly proud of.
I'll try to keep this brief because there's nothing duller than hearing a resume recited, but I am the Adolf A. Berle Professor at Columbia Law School. Mr. Berle was a famous man. I specialize in securities law and white-collar crime, and they overlap a lot these days. And I've written a number of books, but I don't think listing those titles would be helpful, and a number of case books, which are long and not easy to read, frankly. What have I done that's interesting? Well, let's see. I'm a fellow of the American Academy of Arts and Sciences, which was founded by John Hancock, John Adams, and Benjamin Franklin to replace the British Academy a few years ago, and we think we're an important honorary society. There was a study done at Chicago about 2 or 3 years ago. Who are the most cited law professors in the law reviews? Law reviews being the principal means by which legal scholarship is published. And that study found that in the areas of private law, corporate law, business law, I was the most cited. That proves nothing other than people know who you are, but doesn't prove anything about the legitimacy or originality of your thought. It could be everyone else wants to disagree with you, but that's one statistic. Let me get off anything in the past and say, I'm doing interesting things today. Tomorrow, I'm participating as one of the organizers in an organizational meeting that will set up what we call a shadow SEC, which is a group of maybe as many as 10 distinguished law professors who are specialists in securities regulation, and we will report to come out with sensible advice to the new Trump SEC from time to time over the next couple of years, because very significant changes are being planned, and some of these strike us as a bit reckless or harebrained even. So we'll be an organized group that tries to give informed commentary on current issues of securities regulation, and I'll know more about how well we're doing after the organizational meeting tomorrow. Okay, is that enough background?
Great. I'd like to kick off with the shadow SEC. Is that to be a partisan or nonpartisan group?
No, we're not going to be a partisan group. I think we have people who are either Republicans or at least are not Democrats. But our goal is to comment on specific proposals being made, and we will try to avoid the pure Democratic Party line, because the real hope of something like this is that we have a closely divided Congress, and if you can convince 3 or 4 representatives or 3 senators, you may be able to prevent a majority from forming or force that majority to make some adjustments and compromises. Now, I'm not saying that we will have great impact, but I think it's worth the effort if you get even a few controversial issues to be reconsidered and modestly adjusted.
What are some of the controversial issues?
Oh, well, I'll give you a very short list. First of all, are cryptos securities. Cryptos you are familiar with. Bitcoin is the leading example, although it is not considered a security. But these kind of special high risk, highly volatile investments could be very dangerous for the ordinary investor to put any significant portion of his portfolio into. Under the current administration, the Biden administration, they have been regarded as securities, and they really can't be issued in the United States without there being a full-scale registration process. It looks like the Trump administration is absolutely of the polar opposite position. And in fact, Donald Trump has his own cryptos company and is planning to have that organization extensively trade them. Thus, cryptos are a whole new investment class, and whether they escape the oversight of the SEC is going to be an issue, or at least how much should they escape of the oversight of the SEC? You might give other agencies some power, but still let the SEC enforce the anti-fraud laws. So that's one issue. Let me mention just one other. There is the whole issue of climate change. Probably the most ambitious and aggressive proposals of the Gary Gensler SEC, the current SEC, are for regulation to require much more disclosure of climate change and toxic emissions. It's not seeking to bar anything, it's seeking to give investors information, and there is substantial reason to believe that the most sophisticated institutional investors do have a desire to know more about a particular company's involvement in carbon emissions because it sees in the long run that they're going to face problems if they are a major emitter of carbon. So there are all these proposals that have been adopted into rules by the current administration, and they may all be reversed either by the Trump administration or by a number of conservative courts that are hearing challenges to them. But we want to have our voice heard in that loud and confusing debate.
Going back to crypto for a second, obviously you're more of an expert on the, I'm quite knowledgeable about the space, but you're more of an expert on the nuance of the legality. But as you alluded to or stated, Bitcoin is considered not a security.
That's correct. They don't have
Right.
any controlling group that's benefiting from them.
But so for other crypto, if they chose to structure them differently, more akin to Bitcoin, then they too would not be securities. Is that not
It is
correct? Or
possible there are other, I think Tether, I think there are other instruments that are not considered securities by the SEC. But the reason they're not considered securities is there's not some controlling person behind there who's benefiting from selling these securities to the masses. Once we have someone who is effectively the owner of the business, we're going to treat the passive investors in that business as people who have purchased securities. That's the current position of the current SEC, and clearly not the position of either the Republican policy platform that we had the last election debating, or of Donald Trump himself, who is very involved in cryptos.
understood that's the nuance that I was looking for. Thank you. And then in terms of climate change and the disclosure, so where do you think that should fall? Where do you what's wrong? What I mean to me,
Well,
uh,
we want to give investors the information they want, and they, in the case of the institutions, have indicated pretty strongly that they want to know about the carbon emissions you are causing, because that's going to be a topic for eventual regulation or eventual, perhaps panic-stricken regulation if there is a climate crisis. We may already be in a climate crisis. But the goal there is to, as the SEC has always had it as goal, to give the information to investors that they want and believe they need. And there's considerable evidence that the most sophisticated investors do want information about the amount of carbon emissions that you're causing and the cost that you are bearing as a result.
I don't disagree. I think where it gets tricky is so for scope 1 and 2, I think those are pretty clear. Scope 3, I think is Well,
Well,
is
they've backed off of that. The final rule adopted by Gary Gensler's SEC did not require any disclosure of this third category, which really is the amount of carbon emissions that the purchasers of your products are causing. It's much harder to get that information. Think about it, General Motors. They sell cars to the public, and the public drives them and emits a great deal of carbon emissions. It may be relevant to tell investors just how much damage to the environment the customers using this product are causing. But that's not in the current rule. That was a compromise that backed off of that very, very explosive topic.
Yeah, and personally, I mean, for what it's worth, I think that was a good compromise because my
Mhm.
my understanding is there's considerable overcounting and double counting with scope three as well.
Well, anyway, by the way, this is being required in Europe now, but the U.S. is well behind Europe in terms of disclosure of environmental problems.
Right. And then shifting gears to governance, we recently had a fellow Columbia professor, business school, it happened to be Shiv Rajgopal, on, and let's use his view as a straw man. So the vast majority of equities at least in the U.S. are held by two constituencies: passive indexers and active quants. The former doesn't take a fundamental view on governance or corporate issues, and the later is generally quite short term, if not high frequency. But both have the result in the same outcome, which is effectively that there isn't a strong view on who is or should be running the companies and how well they're run, and to that extent, voting is nominal, if at best, often. What's your view? I believe you have some pretty strong views on this.
Now, I would agree about who are the shareholders. Let's start with this fact.
Okay.
73.5% of the stock of the typical U.S. public corporation is held by institutional investors. And they probably break down, in my view, into three clearly definable and differentiable groups. There are, first of all, the activist investors. These are principally the hedge funds. And activist hedge funds actually look for companies that are poorly performing, that are trading at values well below what they might trade at if they had superior management or a superior business model. And the goal of the activist investors is to come in and buy these weak performers, change management or change the policy, and get the stock price up through active intervention. So they want to be active managers, but it is possible to say that they're only interested in the short run. They only want to hold this stock till they make their changes and hold on for maybe a year, year and a half, and to see that the stock is beginning to respond to these changed policies. That's group one. Group two, even larger, are the index investors. Index investors are fully diversified markets, fully diversified investors who do not seek to outperform the market. Rather, they seek to match the market, finding that to be over time a very successful, healthy rate of return. The leaders of this group are the so-called Big Three: BlackRock, Vanguard, and State Street, which hold huge portfolios, but because they hold huge portfolios and can't monitor every company, and because they are largely immune from firm-specific business risk because they are fully diversified, they are thought to be largely passive. Now, that may be an overstatement about their behavior, because I think they do have considerable interest about areas in which they are subject to systemic risk. I'm differentiating here ordinary risk and systemic risk. The definition of systemic risk is it's the risk that remains even if you're fully diversified. Diversification wouldn't protect you as a company if the sun were to be totally eclipsed tomorrow for the next year. That is the kind of risk that you aren't protected by through diversification that these investors do focus on, and it leads them to have some real interest in corporate governance. I don't think that BlackRock, for example, regularly is in communication with its portfolio companies, but not about the management of specific products or the specific business. Okay, now those are the three. The third group are the quants, the quantitative investors who have special mathematical logic and formula that they follow to develop a portfolio that they think will be superior to an ordinary diversified portfolio. Anyway, those are the three groups, and it's possible to see one as being excessively passive, Two, the activist investors as being excessively focused just on short-term issues about management and policies, and the quants as being no one really understands the quants, so their impact on others is relatively small. That's the backdrop. They behave quite differently. We have this 73% group of all shareholders, but they behave very differently because the activists tend to be shorter term holders, whereas the index investors are permanent holders. They will always be there, and they develop a long-term quiet relationship with senior management at the portfolio company because they'll always be there, and management wants to have them on their side and have them be supportive, particularly if they face a control contest. Okay, so that's how they are set up. The behavior between passivity at one and hyperactivity on the other on a very focused topic, but not a long-term involvement, that tends to produce some possible tensions. Basic point, though, is that the activist investor, while it has a very large block and may have a group of allies to whom it tips its intent to intervene and lead a control fight or a fight for representation on the board, those people find that the index investors can be an obstacle. Now, that's played out in some recent cases that we might get into, most notably the attack by Elliott management on Southwest Airlines. But you do see that there are differences of opinions within the institutional investor community. Let me leave it at that and see where you want to go next.
Yeah, let's shift into the Elliott circumstances with Southwestern Airlines. Again, I had the privilege of being at a symposium you hosted at Columbia recently, and I heard your views. But for the listeners on this podcast, I'd love to hear your synopsis of the situation and
Okay,
and thoughts.
let's identify the parties, for not everybody is familiar with this. Elliott Management is one of the largest of the activist investors, and it's particularly known for an aggressive style. It stays within the law, but it has, as everyone acknowledges, very sharp elbows and is very competitive. Okay, they decided they were interested in making a large investment in Southwest Airlines, which is a classic company on which institutional activism is likely to focus because it's lagged the market for several years and it's way behind its other airline rivals in stock market price. Okay, so it makes a very large 10%, 11% investment in Southwest Airlines. And it announces to the world that it is going to seek major changes, including the ouster of both the CEO of Southwest and its chairman of the board. That's a full-scale attack, and there was little attempt to simply say we wanted to negotiate and discuss. They wanted to replace senior management, and they had very sharp operational differences in mind. Okay, that is atypical for a couple of reasons, most important of which is it's unusual for an institutional investor to seek actual control. They announced that Elliott announced that it was going to put up candidates for 10 of the 15 seats on Southwest board. That means if you were successful, you'd have a 2/3 absolute majority, and that's quite unusual. Now, the reaction to that is not clear-cut. No one identifies themselves as being for or against Elliott or necessarily discloses their own vote. But having called a shareholders meeting for what it would have been next week, Elliott called it off. They agreed to a compromise under which they got 4 seats, a very real representation on the board, but not uncommon. It often happens that such an insurgent can get 4 seats on the board. It just happened to CVS also this last couple of weeks. But they did not get a change in management, and they did not get a majority of the board. Why not? When they were organized, management had a weak case in terms of their recent performance. And I think the answer has to be that the index community, the big three and others, were not happy with giving absolute control to Elliott. This is what I'll call a well-recognized protocol. The institutional investors of this world do not want one institution to get control unless it's willing to pay a control premium in which they share. Otherwise, you've got someone who is in control and may be able to use control to accrue the private benefits of control to itself. Elliott may yet win this contest, may yet get control of the board, but they couldn't do it quickly because they were forced to back off. Someone was putting their foot down and resisting. My guess is that it was at least in part the major index investors, including some of the big three. Okay, that is the kind of division we see. Some companies would love to come in and win a proxy fight and take over the target. But they have faced the reluctance of other institutions that want a slower paced process. They want to see a divided board debate these issues and make more piecemeal changes to get to an end solution. They don't want to see an overnight reversal with a total change, as if we had an election and thrown out the entire company, as we've just done in our presidential election. So we see more gradual progress towards what might be a goal that both sides can agree on. That's the point I'm making here, that although we have institutional investors owning 73% of the stock, there are divisions among them about the pace of change and about whether or not one person should have absolute control of the board by having 2/3 of its directors. Instead, we're seeing longer, slower negotiations, and I think that probably is healthy, but there could be debate over that. That's a quick summary of what happened in Southwest. Southwest has, by the way, also had improved earnings, which they announced just before the last election, and that also the outcome could also reflect some improvement in Southwest's performance.
Two thoughts on that. One, two possibilities. I'd like your opinion on. One, is it possible that they were just trying something outrageous to see if it might work and they could get away with? And then the second question was, might it just have been a negotiating tactic? They start with 10, the other side's at 0. So the compromise, you split it at 5, and in this case, 4, close enough.
Well, you see, you have to find someone who's got the ability to oppose them. Elliott has shown a willingness in the past to use the power it has. It is, as I said, sharp elbows are their characteristic. If they could have elected 10 directors, I think they probably would have wanted to. And management didn't hold enough of a block of stock to seriously oppose them. Management these days does not hold a large share of the corporate stock. It's probably well under 5%. So if Elliott's got 10 to 11% and probably has a wolf pack of allies that might own another block of stock, to see Elliott being frustrated, you have to identify someone in the background who could outvote them. And I believe the only real such candidate would be the big three and other large index investors. Now, they didn't have to themselves take up and lead a fight. They could rather have the management of the company saying, we have assurances from the big three that they're going to support us and not give you absolute control. And that could well cause negotiation. And yes, with 4 directors on this board, it is quite possible that at some point in the future, if earnings continue to be flat or to dip, that we will see Elliott get absolute control, but we're not seeing it happening overnight. That kind of blitzkrieg attack is something that violates the protocol that I think the index investors like, which is we want a divided board arguing, negotiating, and determining how quickly they should move with respect to what might be new opportunities as they arise. That's the second question. What was the first that you also had?
No, you addressed it adequately. Thank you. This is a good. I think now's a good time though to shift to Tesla, which is once again in the news. Where, if I'm not mistaken, the Delaware court once again, or for the second, you correct me on any of the details, as you're far more knowledgeable on the nuances. The Delaware court for the second time rejected Elon Musk's pay plan. And I guess the question for you is, well, at a high level, is there a threat to Delaware's former dominance in governance, corporate governance and law? And then perhaps specifically on this case, what your thoughts are?
Well, people disagree, but I do not think Delaware's position is at all challenged. Remember, this is what has happened is that the Chancellor of Delaware, Kathleen McCormick, has twice ruled that Elon Musk did not successfully secure an independent vote of the shareholders because there was a failure of necessary disclosures. How will this impact on other firms' choice of incorporation? Will they want to move from Delaware to Texas, which is where Elon Musk has moved Tesla? It's now a Texas corporation. And eventually, they may again, for a third time, attempt to obtain his very wealthy compensation package. Literally, the package that was at issue there was an incentive arrangement under which he got $56 million worth of Tesla shares if earnings went to a level. And earnings did go to that level, but everyone else who's proposed plans like this has put some ceiling. No one else has gotten anything like even a $10 billion one-time incentive compensation award. And this money is important to Mr. Musk because it essentially is the bulk of his vast wealth. Thus, it was a very important case to him, but that makes this one-off. We have a controlling shareholder. We generally do not have controlling shareholders at American public corporations, and the controlling shareholder saw his best interest as getting outside of the oversight of the Delaware court. By the way, I should also add, this was a decision of the Delaware Chancery Court. She was the chancellor of that court, the head of it, but it was still subject to appeal to the Delaware Supreme Court. We don't know what the Delaware Supreme Court would rule on a rather controversial case where there is a division in opinion about whether or not the shareholder vote should have been respected by the court, by the Delaware courts. However, I think the facts are so unique, I don't think it's going to lead other corporations to move, and other shareholders may not want their CEO getting a $56 billion compensation package awarded by the board of directors. That board had non-independent directors. Mr. Musk's brother was on that board and voted for the stock award. So I will agree that this was a close case, a controversial case. Opinions divide on it, but I don't think it's going to cause a major shift because the competence level of the Delaware courts in the area of corporate law vastly exceeds that of other state courts, and also, I believe, is at least equal to that of the federal courts. So that I'm not sure you want to go to a much more politicized court where in Texas, the judges are all elected by a vote. There are very controversial campaigns and other issues, the issues that bother us constantly about transgender students and the like, are the dominant issues being decided by the state courts. Delaware has a very specialized system of a chancery court that basically 80% of its workload is handling corporate law decisions, and they're very expert in that. And the case for an expert specialized court that focuses primarily on corporate law issues is a strong case to many corporate managements. We'd rather have this decided by true experts than by politicians who are now holding a position as state Supreme Court justice. That's a quick summary. You have further questions on it?
No, I think that was spot on. Thank you. You wrote a critically acclaimed paper, The Agency of Activism. For those listeners that may be more on the investment than the legal side or less familiar with it, what, in your view, should we learn from it? And is it effectively a bear case on activism?
No, I don't think it's quite that. I'm not trying to shut down activism. I'm not saying that it should be stopped. Mostly, there are minor changes in securities law rules that I think will give us more transparency and more early disclosure. I think you might have the title wrong there, but this was a paper I wrote about what's called the Wolf Pack. The title involves the wolf at the door, and the Wolf Pack are people who get tipped by a activist investor. Suppose I am Elliot, just hypothetically, and I decide I'm going to launch a campaign to get control of the board of a Southwest. I can tell people in the investment community that I'm about to announce that I have crossed 5% and I'm going to lead a proxy fight to change management. If I make that advance announcement before public disclosure, most of those shareholders will realize it's in their interest to buy the stock before this news comes out, because typically on the announcement of a proxy challenge or a 13D filing by the company, the stock price will go up 6% to 7% net of the market. That's a huge one-day return, and you want that kind of information. You'll be very loyal and friendly to get that information regularly from leading activist investors like an Elliott Management or one of the other most active such investors. Okay. In this world in which tipping is going on, it's not illegal insider trading. Take too long to explain why, but it's not illegal. It does tend to suggest, however, that if you've gotten this information that's going to make you quite wealthy days before it's publicly announced, you have a close relationship, and you should be seen as a group. And we should have a disclosure, as the securities laws require, anytime a group passes the 5% threshold. So if an Elliott talks to 3 or 4 other large hedge funds and says, here's what we're going to do, and learns that they are going to buy the stock and be ready to vote for those proposals, you may have a group form that has to disclose itself earlier. And I think the more we get full disclosure early, it's desirable, and it prevents the sudden attack that overpowers management and leaves it unable to respond. I'm not saying management is powerless. I'm just saying the fact that you tip information to someone who's going to get very significant one-day returns suggests that you're more than just a casual friend. You're acting together, and the securities laws already require that a group disclose once the group collectively holds more than 5%. And on the formation of such a group, as shown by tipping, there would be a need to disclose at an earlier stage. That's an in-between reform. It's not going to prevent activist hedge funds. It's not going to, what it's going to do is give management a little bit more time to get its act together and see if it can mount a defense.
The only nuance that you've lost me on is I thought if one has a group, one has to disclose it as a group.
But what shows that you're a group? You'll always write letters back and forth to each other saying we're not a group. However, given a gift that may be worth 20 or 30 or even $100 million in some cases, a 6% rise in the stock price, that may be evidence that you are a group. And the SEC has made a slight step towards agreeing to these proposals, though that's still not gone far enough in my judgment. The question is, what defines a group? It is not defined in the statute, and the case law is somewhat ambiguous. And I think a rule that says if you're tipping these people about your future conduct and they can profit immensely as they decide, then that suggests this relationship is not arm's length. You are a group.
And it's not falling under the auspices isn't the right word, but it's not falling under the material non-public information if you're tipping like that.
I understand that insider trading requires that you owe a fiduciary duty and that you breach a duty to the shareholders. The typical hedge fund is not a fiduciary. It is not a director of the company. It is not a controlling shareholder. It is merely a 5 or 6% holder, and thus it would be allowed to tip information about what it is going to do because it's not a corporate insider. The insider trading laws basically apply to the corporate insiders, and a 5 or 6% holder that is going to announce that it wants to run a proxy fight is not trading on non-public information that breaches its fiduciary duty.
Right. Okay. That makes sense. You wrote a book, The Impact of the Hostile Takeover. I was once with a top lawyer who you know, and his contention was there is no such thing. At the end of the day, 99.9% of takeovers are not hostile.
At the end of the day, that may be true. That's when you're negotiating only for some golden parachute or some other special executive compensation. Let me give you the other side of this, because I would tell you that even friendly deals have a very hostile element. People are wondering what happens if this deal is breached. Think, for example, of Mr. Musk's takeover of Twitter. He made a very generous offer and then turned around and decided he didn't want to pursue it further and wanted to call it off. And that produced a litigation that he eventually lost. But it was because all of the parties were protecting themselves at each stage by negotiating very elaborate rights as to what would happen if he tried to call the deal off, that Twitter was able to force Musk to consummate the acquisition. That's the world in which people are looking at each other with some suspicion, and properly so, and so also are friendly deals. the friendly deal, you want to know what will happen if they decide not to pay the price you thought they were going to pay, or if they decide to pay a different price to someone else. There could be real concern that they will pay a higher price to some large shareholders than the price they're paying to you as a medium-sized shareholder, only a couple 100,000 shares. That kind of world produces careful lawyering and concern. And when you have billions at stake in a takeover, everyone has a tendency to be looking out of the sides of their eyes at each other to make sure that the deck is not stacked. So I think that you do see a level of concern that suggests that they have suspicions that they could be cheated and they want to have careful protections. Now, whether we call these deals hostile or friendly, what is really clear is there's a conflict of interest. Management is going to want to be negotiating special compensation, golden parachutes, or long-term employment contracts for themselves. That can be contrary to the best interests of shareholders, so that shareholders have a reason to be concerned about management getting more of the takeover premium than they otherwise would have through special compensation. And similarly, shareholders can be concerned that the insurgent, the person seeking to make the takeover, is willing to pay a side payment to senior management to get their acquiescence in the deal, even though a more disinterested CEO of the company would negotiate for a higher price. Everyone has a conflict of interest in these deals, and that produces something that is very, very careful lawyering to protect your own self-interest.
Understood. All right. And on a different note, what's your do you have a favorite book or a one you've read recently that you think is worth sharing?
Oh, I don't want to go down that. The last book I read was a very comical book about cats in France, and you won't. I wouldn't recommend it to you because it's too simple. I read for entertainment, or what a scholar really does is read the law review articles and the other studies and reports that are coming out, which are not in novel form and don't have the genius of Tolstoy behind them, but have a law committee that's researched and gathered some data. Uh, and so, for example, the shadow SEC group that I'm working on, that would be issuing reports or commentary or holding meetings at which they might criticize the position of the real SEC, hoping to get some debate and some modest movement and some possible adjustments in overbroad rules. That's not a fiction work. That is something that, unless you're a specialist, would probably bore you. So if I'm going to relax in an evening, I'm more likely to turn on Netflix than I am to open up a novel. And that may be a poor commentary on my judgment.
Ah, all right. Well, fair enough. I had the you mentioned the shadow SEC a couple of times, and I had the privilege of being a portfolio manager for Scott Bessent at Soros, and he's also
Well,
spoken at our
okay.
class at
I'm
Columbia.
well aware of Mr. Soros and his record, and I'm aware that some of his proteges are now about to hold significantly high positions in our next administration, including Secretary of the Treasury.
Right. And the segue there, though, was Scott had proposed a sort of shadow, or it had proposed and or been a proponent of a shadow SEC, and that sort of got considerable backlash. And my question is your propose, and he's sort of, I think, backed off on it publicly. My question is your proposed shadow SEC, how is that being received?
Well, it hasn't even been announced. We don't have the members and lined up officially ready to sign on until late Friday, and it will be announced in the Columbia Blue Sky blog I hope, next week, if all goes well. And will we be controversial? Hey, you're irrelevant if you're not somewhat controversial because these are controversial topics. This is not a totally new idea. We've had shadow central banks. We've had a shadow Federal Reserves, and a group of business economists who know something about financial economics will hold meetings and say, if I was sitting today, as the Federal Reserve Board is about to do today, I would decide to move interest rates this way and not that way. And I am critical of the decision they made yesterday to increase or decrease interest rates. And here's why. This is an informed discussion framed and more or less set by what the actual agency is doing. We're not about to rewrite the securities laws. That wouldn't work. But we might say these proposals are a little ill-considered, and I don't think they realize what the actual implications might be of what they are proposing to do.
Sounds good. Sounds fair. Anything we didn't discuss that I should have asked you, or you're discussing with other investors?
I think to put this all into a fuller framework, we should recognize that there has been a tremendous change in the M&A marketplace and how it works. When I was younger, considerably younger, back in the wide open, hot 80s and 90s, you had true hostile takeovers. They were partly curbed by the invention and judicial acceptance of the poison pill, so that the only way you could do a hostile takeover is getting a shareholder vote. But these things were led by the actual bidder. What we have now are activist hedge funds who are much smaller. A bidder could make a multi-billion-dollar, $10 billion tender offer, and did. Okay, but the typical hedge fund probably doesn't have the ability to come up with more than a couple of billion, and that would leave the upper half of the New York Stock Exchange beyond their reach. Instead, we have a contest in which announcing a reform set of proposals and new proposed business policies, you seek to elect 2 or 3 directors. You don't make a takeover, but you get a significant voice on the board, and that significant voice on the board may, if it's persuasive to the other directors, be eventually able to get those policies adopted and possibly to get management turned out of office. That's different than the all or nothing takeover, which was a very sharp guillotine, and it just replaced management and took the company over. Now we have a slower process that is a little bit more deliberate, a little bit more well-informed. I think that it works relatively well. I'm not someone who wants to throw the baby out with the bath. That's why I want the shadow SEC to try to keep Congress from legislating in a manner that totally disrupts and destabilizes and decimates the existing SEC.
John, we'd like to thank you for that interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for what one of our more thoughtful and innovative professors and authors is thinking about, and how we may all benefit from this as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.